Okay, in this video, I want to talk about reporting styles. Okay, I've mentioned reporting styles in other videos, and I want to go back and refresh your memory about what a logical system is. So basically, a financial report is a logical system. A financial report is not illogical. It's not arbitrary. It's a logical system. It was created by man in order to achieve the ability to exchange information about the financial condition and the financial position of an economic entity. So it's basically a logical system or a logical theory or a formal system. So a theory is made up of a set of models. A model is made up of a set of structures. A structure is made up of a set of statements. So a statement is any proposition or claim or assertion, belief, idea, fact. And there are four types: terms, associations, assertions, and facts in a report. Okay, so it talked about the notion of intermediate components and people in a financial report. Economic entities are allowed to move around the items in a report to a degree within the rules of the financial reporting, so that basically there's a permissible set of manipulations that they can make to that report, and those relations are described in the accounting standards, and they're basically rules that drive what you are and are not allowed to do in a report. And those, what you can do, it's basically, they're models. I mean, a reporting style is basically a model. And it's a permissible pattern of financial reporting. So I've analyzed both US GAAP and IFRS, and I'll show you examples of both. I've done more extensive analysis of US GAAP, but they're pretty much, they're very similar. They're more similar than they are different, US GAAP and IFRS. So anyway, I'm going to show you some reporting styles. And here is a basic classified balance sheet. On the right, you see the line items that were actually reported by an economic entity. And on the left, you see the model of this type of a statement, a classified balance sheet. You have these things on it. And I mapped from the details to the summary report. This right here, I wanted to point out, this is not actually reported anywhere. Non-current liabilities. So it's derived by taking liabilities and current liabilities and subtracting current liabilities from liabilities, and that's how non-current liabilities is determined. So exactly the same thing happens with non-current assets. They don't report that line item either. But basically, you can take this and pull information out of it and reliably use the information. Okay, and this is a pattern of a balance sheet. Another pattern of a balance sheet is an unclassified balance sheet. And there are certain industries, for example, banks, that use an unclassified balance sheet. Another type of balance sheet is a net assets balance sheet. This is IFRS, so here you have net assets liabilities. So you have total assets, total liabilities, then total assets minus total liabilities is net assets, and that equals total equity. And then here we have another alternative balance sheet. You have non-current assets broken into two pieces: fixed assets and other than fixed non-current assets. But the total of these two things equal non-current assets. And here you have balance sheet of a regulated public utility. They have capitalization, and that's mapped. So anyway, those are the balance sheets. So here's some income statements. The most variability that exists in statements is in the income statement. Here's one type. This is the most common type of income statement. And this is IFRS. This is the same pattern in US GAAP. So the IFRS and the US GAAP, the terms are slightly different, but the line items are basically the same thing. And then you have more patterns for income statements. You can stop and look at these if you want, and there's other information I reference where you can find out a lot more information about this stuff. But the point is that there's variability in these reports because the intermediate components, the subtotals, are organized different in different reports. Financial reports are not forms. So you have variability, and this can be handled no problem by XBRL and the standard business report model. So to summarize this, balance sheets, the blue and this brownish orange or whatever it is, this is classified, this is unclassified, and this is the rest. The first two are the vast majority of the different models of a balance sheet. Cash flow statement is similar. This is the first, this is the second, and this is everything else. So they're very consistent. The income statement is less consistent, but still very consistent. This is the most common income statement. And then you have these here. This is actually either other known and unknown styles. So the most important piece here is knowing that 90% of these entities that use these reporting styles use 29 specifically identifiable styles. Another 5% use 27 identifiable styles, different than these 29. So that's about 60 different styles. Then the remaining portion, you have 114 entities that, and the worst case scenarios would be that each entity had a separate, unique reporting style. But that's probably not the case. You probably may have, 5 entities that use the same style, another 3 that use the same style, or maybe larger groups, 10, 20. But they're smaller groups than these, there's literally almost 2,000 companies use exactly the same reporting style. And, these 3 alone are, a lot. So, again, what I'm trying to show is, number one, what a reporting style is. And it's basically a model. And that there's not a lot of variability. It's not like there are thousands of different reporting styles. There are hundreds. And this variability is inherent in financial reports because of the way that companies are allowed to report. And maybe some of that needs to go away. Maybe it doesn't. Maybe there needs to be more. Who knows? But that's not the point. The point is that you can observe this variability because of the different ways that entities organize the core financial elements in a financial report. That's why the variability exists. Financial reports are not forms, and XBRL and the standard business report model handle this. So I'll call that good.